Hello, and welcome to the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. I'm Josh Metal, and I'm here today with Christopher Fontana, co-founder and financial advisor with Florida Medical Advisors, proudly serving clients in all 50 states. Chris, welcome to the show. Tell us a little bit about your background and how in the world did you land in the financial service industry?
That's a great question. Thank you very much. And it's a pleasure to be on here. I started out, 20 years ago working in finance and actually on your side of things, in the mortgage banking industry. And it was doing really well, managing a team, more and more production every single year. And then it was around 2005, 2006, where, again, if you've seen the movie The Big Short, I didn't have any kind of inside knowledge, or if I had, I'd probably, jumped out sooner, but I started to sense something was wrong. And it was like 2006 and 7 where I started to lay the groundwork to move into another type of financial career. And I started exploring and getting licenses and so forth to become more on the advisor side than on the mortgage banking side. Made the switch entirely in 2007 going into 2008. Was at a different firm for a little while, really not focusing on physicians. And then, as I was sharing with you before, just had a really good friend, really good friend who my wife had introduced me to. My wife is an RN. So she had a couple of doctors that she had become friends with working the night shift. And she had said, hey, there's this one guy at the hospital. He's about our age. He likes hockey. You like hockey. You guys should get together. And I'm like, yeah, what? That sounds like fun. And he and I became really good friends. And as he graduated from residency and became a doctor in his own right as an attending, as we would sit at those hockey games in the intermissions, he would say things like, I wish somebody would have shared with me the things that the conversations we have about finance. I wish somebody would have told me all this stuff when I was still in my training, before I had the income and had made some mistakes. Long story short, he became a client. He then introduced me to some of the other doctors that he works with. He eventually became the chief of his department. And obviously at that point, we started doing things with his program on an official basis. So we go into residency classes on finance. We call those financial residencies. Nothing catchy about that. I know there's probably a lot of people that would use something similar to that. What I like about ours is that it's very much meeting them where they're at. And so that's been our focus, is helping them to just make, in fact, if you look at the website, help them to make great financial decisions and really just making good decisions, right? So when you've got that income, that's where we started. So that was my start, and it was a lot of fun. We did it, like I said, for a long time now, 11 years. We've been working primarily with medical doctors, dentists, and veterinarians. So those three verticals. We also have a lot of mid-levels, because obviously a lot of the doctors will introduce us to their nurse practitioners or their physician assistants that work in their offices or their friends. And so we have a smattering of those as well. But I love it. Just like you, I like working with a very targeted clientele, and it's been a lot of fun.
Well, and Chris, our audience is diverse in that it's not all medical professionals and doctors who are going to listen to this podcast. But what I think, we definitely have in common is that the vast majority of our listeners are young. They are highly educated. Most of them have relatively high incomes, and many of them are highly indebted. And whether you're in the medical profession or another profession, these similar challenges are the challenges that we really want to talk about and help you overcome and really become a strategy. Your friend was lucky to have you as a hockey buddy and as a financial mentor. So we're going to try and instill all that wisdom of all those hockey games and all those conversations down to a 30-minute conversation. And I think where I want to start, Chris, is, with our average listener, our typical listener in mind, the millennial that is highly educated and has spent the vast majority of their time and energy really focused on their profession, not so much focused on their finances. and then coming out of school, presumably with a decent amount of student loans. And really the question is like, what are the crucial things? What's the top advice to give young professionals for their first 5 to 10 years into their professional career? Where do they start?
Yeah, it's a great question. So the focus, and there's a lot of podcasts out there. You and I are probably familiar with several of them, but White Coat Investor, I hear that all the time, White Coat Investor. And in fact, whenever I do any kind of educational classes, I always ask the attendees, like, how many of you, White Coat Investor, raise your hands. And it's usually about maybe a third of the audience is familiar with Dr. Daly's work and his book and his podcast and his website and everything. The focus, typically, they come out of school and a lot of the generic information. So think of it this way. If I go on a diet, and let's say that it works really well for me to do a keto diet, and I'm like, man, this is fantastic. I lose a ton of weight on it, and it worked really well for me. Well, problem is that a lot of times people become an evangelist for that, right? So like, what's that you've probably seen that YouTube video about CrossFit, right? So people do CrossFit, all they want to do is tell you about CrossFit. It's the same thing with finance, in the sense that if it worked for me, the inclination is to say it's going to work for everybody. And that's just not the reality of situation, right? So everybody is different when it comes to their metabolism and things, and everybody's different in what they have going on. So obviously, if you're coming out of school and you got $300,000 or $400,000 in student loan debt, that creates a scarring, and I don't mean to be over dramatic here, but it does. It creates a scarring, like a mental scarring, in the sense that that is such an exorbitant amount of money that it creates this drive to, no matter what, I want to get rid of that, right? I want to eliminate that debt, to the exclusion of other things. So one of the first things that I'll ask clients whenever I meet with them for the first time is, tell me what you want to accomplish over the next 3 years. And it's funny, usually student loan debt is like one of the first things that they'll say, I want to get rid of the debt. But they'll also say things like, I want to buy a house. I want to get married. I want to start a family. I want to repay my family who helped me with my college experience, right? Or I want to help my parents out who are, in their 60s or 70s, and maybe they're struggling financially. And so our approach is that you shouldn't have just a one size fits all. Whenever it comes to your objectives and your goals, you really need to have a balanced approach. Yeah. And so if you have a balanced approach, right? So I use a term, and actually I got it from a mutual friend of ours, Daniel Harkavy, who is an executive coach. Daniel used this term, and he didn't use it the same way I do, but I say it all the time: bifocal vision. And so rather than having my eye constantly on the debt, I need to have my eyes bifocal vision. One eye on today, meaning I need to have savings. I need to have some investments started, right? So the sooner you start, the better. But I also need to have my eye on the horizon, meaning I do want to get out of debt, and I do want to retire at some point, at some time, but I don't want to do one over the exclusion of the other. So bifocal vision, right? So one eye on today, one eye on the future. And that's the approach we take with everybody, is that you need to do both of those things well. And you actually can accomplish the elimination of the debt. In fact, most of our clients, not all, but most, are going to be out of debt faster if they utilize the way we tackle it, which is more of a prioritization model, meaning we're going to try to save first rather than make this debt the priority. So I talk a lot about managing the debt. Like, for instance, what you do is you help people get their home mortgages. That's one of the biggest expenses they're going to have. Yeah. If they mismanage that, right? So one of the worst things I whenever I hear somebody say, we just refinanced the house, we dropped it to a 15-year, that's great, because they're only looking at the interest that they're going to pay. They're not really paying attention to the cash flow requirement of that change. Yes. And that's oftentimes that's a big problem. I had a vascular surgeon about 3 years ago now call me up and announce in my over the phone, hey, Chris, I'm so excited. I got a great rate on my student loans. Now, she owed about probably around like $320,000 of student loans, which actually in today's environment wasn't that bad, but about $320,000. Yeah, she's a vascular surgeon though, so she makes really good income. And so she tells me I refinanced them, and she did it on a 5-year repayment. So literally the payment was around $8,000 a month. So $8,000 net payment, right? So that's after taxes. She has to pay $8,000 a month. Shortly after she told me that, less than a year later, she was desperately trying to refinance those loans because she had bought a house, got married, and they were expecting a baby.
Yep.
So because she hadn't thought through all of those future things, and we had discussed them, it's just that she made that decision without actually consulting with our team. And so when it came time to actually, finish the rest of the planning, she didn't have the cash flow to do these other things. So that was a big concern. So for us, it is really a focus on making sure that we're managing the debt appropriately and that we're not making it the priority.
I think there's so much wisdom in that, Chris, and I'm gonna share a different way of explaining that bifocal vision that Daniel uses as an example. There's a friend of mine who drives fancy race cars around a racetrack, and he's working with a professional race coach and driver, and so I'm telling his story here. But he's pulling, they're drafting at 150, whatever it is, miles an hour in and out of the curves. And the race car driver says, "Where are you looking?" And he goes, "Oh, I'm looking at the car in front of me's bumper." And he goes, "Why?" And he goes, "Well, because that's the nearest danger." And he goes, "Pull over." He says, "The problem is if you're looking at the bumper in front of you, you can't see what's beyond." He says, now do me a favor. He goes, look at that sign back there. He says, "Do you see the sign? So your focus is way farther down the road." He goes, "Yeah." And he goes, "How many fingers am I holding up?" He goes, "2." He goes, "Well, how can you see that if you're looking at the sign?" He's like, "Well, if I look further down the path, I can still see what's closer." He goes, "That's right. What race car drivers." And what you just said was, that's what financially successful people do. They look beyond the fear or the urgency, the student loans right in front of them, and they look farther down that path. That doesn't mean they still can't see the burden of the student loans, but they're looking past what's beyond what's right in front of their face.
That's exactly right. Yeah, and that's a great analogy. The other thing too I've heard about race car drivers is that they say don't look at the wall, right? I've heard that several times, right, where if they look at the wall, you're going to go where your attention is. And that's exactly right. So that's a great analogy. I hadn't heard that one about the race car before, but I like that. So I'm going to steal that actually. So I'll use that in a future session. But I appreciate that. Yeah, that's a great point.
Me and you might have to go race some cars together.
Yeah. I'll have to make sure my life insurance covers that. So
call your agent. All right, look, I want to ask you a question about what you said, because we haven't discussed this up until now, but philosophically we are exactly aligned in that it's easy to be sucked into a 15-year mortgage or to sell a 15-year mortgage because you have a 0.5% lower interest rate. But I want to know your opinion, and what you brought up is that what people never factor into that equation is the opportunity cost of what they could have done with that additional cash flow over 15 years. And that's astounding if you have just a 5 or 6% rate of return. That the upside on the investment is always greater than the lower interest rate benefit. But here's the question I have for you. How do you look at these longer term amortizing debts, which I would say, student loans, mortgages, maybe a practice loan, something I'm talking about debt that helps you in some economic fashion. How do you look at those longer term liabilities in light of the fact that we seem to be entering an environment that has higher inflation ahead as compared to what we're used to? Does the future prospect of inflation play into that, wanting to amortize that loan as long as possible?
Absolutely. And, it's interesting because a lot of the physicians that we work with, Depending upon when they graduate from their programs, I have a pretty good idea of what their interest rate is, right? So everybody now we're talking right now, you and I, during the age of COVID, so most of them, if they have federal student loan debt, they've been paying zero interest for the last year, roughly, right? So President Trump and then Biden just extended that even further. So I've had a couple people say, should I be paying down extra on this because all the payments are going to principal? And then I have other people that are like, well, it's zero, so let me not pay anything because I'm not accruing any additional interest. So let me kind of address your question in two parts. So one, obviously the cost of money is going to be important. And so from an economic perspective, what you described is arbitrage, so you borrow at one and you invest at another. That's what the banks do, right? So we know that, and banks do it pretty well. There's lots of banks. In fact, every time I see ground being broken in my area, my heart sinks when I see that it's going to be another bank going up. Or I'm like, really? Can we get a coffee shop in here or something? But so it's that kind of thing. So we know there's a lot of money to be made in those environments. But the issue is, as you said, the opportunity cost. Now, opportunity cost can be measured in economic terms, like actually my investment may do well, right? May do better. However, there's also, what is the rate of return? So let me kind of put it in this. So what's the rate of return of the peace of mind knowing that I have this money set aside? And so with physicians especially, I'll have doctors that say, Chris, I could pay cash for the house. I actually have a pediatric dentist. His wife is a dentist as well. They're buying a $1.6 million home in the Tampa area. So they have very good income. They've saved up very well. They could pay cash. And so I had a conversation with him a couple months ago. He's like, should I pay cash? I'm like, well, what's the cost of the money? And so we looked at it. The interest rate was like 3%. It's very low, right? And so we talked about the peace of mind that comes with having that much cash available or that much. So he is not in the situation. So what is the economic value of not being stuck in a practice that you hate or in a job that you don't like? One of my clients is a urologist. For probably the last year and a half, he has every conversation with him. He's like, I hate where I'm working, And I just kept saying, well, why are you working there? Like, you can go somewhere else, but the job market, again, during COVID, never very good for him to jump ship. So, we had been saving appropriately. And then, just a couple months ago, he decided I'm going to do it and, hang his own shingle out there. And now he's doing his own thing. But so that's one way of looking at the peace of mind that comes with it. For me, I always want to help my clients, as you said, with the car racing analogy is that I wanted them to see a little bit further ahead. So your practice may only give you 6 weeks off with a baby, and you want to take 12 weeks. Well, how are we going to bridge that gap? Cash, right? So either you're going to borrow the money or you're going to have the cash to do it. Yes, it may not have a rate of return. Money in your savings account is probably earning you zero or very little. But what is the mental rate of return on knowing I can quit this job tomorrow? I don't have any stress associated with it. That's the first thing. Second thing is then when I have people that will say, yes, Chris, but my student loan is $500,000 and it's 6%, right? So we start doing the math. We're like, yeah, that's a lot of money that you're paying every single month. But I always go back to you took out the loan in order to have this income that is extraordinary, right? So you're going to make $200,000 or $300,000 or $400,000 a year. And as a business person, we talk a lot in my practice about balance sheets. Actually, we have a software system that we use that utilizes a balance sheet approach. And so for a lot of these physicians or dentists or even like some of the executives that I'll meet that are the non-medical spouses of my medical clients, they'll say things like, I had never thought about my finances as being like a balance sheet, right? They think, when I say balance sheet, they think of money in, money out. And I always explain to them that yes, that is money in, money out is your cash flow, which is very important. But then the balance sheet itself, we want you to think of yourself as a corporation. And a healthy corporation is going to have good assets or good cash flow, but also good assets on the balance sheet. So we want to make sure that you have the wherewithal that if something bad happens, like COVID, And I've been using that example a lot lately. I don't know what the COVID-24 is going to be or whatever you want to, so something in the future, but I do know there's always going to be something. And so interest rates are low right now. So if I'm a student taking out a loan and I'm looking at, the possibilities of perhaps higher inflation in the future, that money becomes cheaper and cheaper, really. So like if I could lock in the cost, whether it's a refinance on the student loans or the mortgage, I'm encouraging a lot of my clients, not all, but a lot of them to explore, hey, let's, you took out this loan. I know it was only 3 or 4 years ago, but you got like a 4.5% rate on the 30-year fixed. You might be able to get like a little bit lower rate. We can save up that cash flow. A lot of people have been wanting to do improvements to their properties because they've been stuck at home for 12 months. And so those types of things, those conversations, that's where I want to be involved, because those small decisions are going to have very much like rippling effects over time. So that's a great question. But hopefully I answered your question. Like the way I look at the cost of it, the opportunity cost, but I like to express it in terms that are not just the financial. There's a lot more to it.
No, you answered it great. And what I've been thinking a lot about recently after reading Buffett's annual shareholder letter, where he alluded to this 40-year period of lower inflation and the pendulum swinging the other direction and higher inflation. Yep. Ray Dalio's been writing a series of letters on LinkedIn. Basically, the last one was just saying, you're crazy buying I can't figure out the logic behind buying a treasury bond at 1.6 when, it looks like inflation's going against us here. And you bring up the thing of the point of arbitrage, and then I'll drop this and let's move on. But here's what I keep thinking about, Chris. If a mortgage is, let's call it 3.5% today, and inflation goes to 5.5%, and we assume that wage growth follows inflation, whether it's direct correlation or there's a lag, what have you. So in my mind, I'm saying that means there's 2% arbitrage, right? Because inflation is moving fast, is at a higher rate than interest. So fast forward that 10 years down the road, I'm way ahead. I'm 2% a year times 10 years. The value of money is 20% less valuable. So I want to pay that back with $2,031, not $2,022.
Mm-hmm. Right. Yeah. So and depending upon what we see with wage growth, and that's the other side of the coin, though, so that you do have the increase in incomes with some of these medical, but a lot of them, interestingly enough, though, Josh, whenever I talk to them, a lot of times the physicians coming out of school, very pessimistic, their idea that, wages aren't going up for doctors anymore. I hear that all the time. And I like to bring up that I have a client that is a physician. He's a hospitalist, and he works at the Veterans Hospital that's here in the Tampa area. And so, looking through his Social Security statement, because he's getting close to retirement now, and I'll point out to these young doctors, I say, look, this person, hypothetical, I'm just explaining to them, this person, what do you think he was making in 1995? He was a hospitalist. And it's funny because they'll say things like 200,000, 300,000, because they're thinking like he's probably making the same as what he would be making today. And because in their mind, they're thinking there's been no wage growth. And then I point out to them, I go, he made 90,000. As a doctor, as a hospitalist in 1995, made 90,000. That same salary today is like 250,000. So what is the increase in the income that this person has experienced? And then I'll pull up a calculator and I show them the growth on that. And I say, okay, he experienced, like a 6 or 7% annualized increase to his income over that time frame. Even if we're really pessimistic and we just say that your income grows at 3 or 4%, and you're starting out at a higher number than he is, maybe at 250 to 300,000, depending upon the specialty, you're going to earn $20 million over your career. And you can see in their minds, like it just kind of blows their mind because they had never thought of it that way, right? Because again, all they can see is the student loan, like directly in front of them. So the idea of, wow, I'm worth 20, like I like to do that, especially I have a husband and wife. If one of them is medical and the other one isn't, I love it. Like look at her. She's worth 20 million bucks. And So we need to make sure that the machine is protected. And so let's kind of move on to that. Like, how do we make sure that all 20 million of that, which you work so hard for, that you experience and you get all of that growth?
Yeah, I mean, the simple question is, if you've got a fixed dollar amount of student loans and a fixed interest rate, do you want to pay it back at the $90,000 salary, or do you want to pay it back when you're earning the $220,000? Because the cost of money, which is the interest rate, is fixed on that longer amortized student loan, let's assume. But the value of money is variable. And the more inflation that we have, the lesser value of money. And all day long, I want to pay that student loan back when I'm making 220 versus 90. So that, I think that was a really, really valuable takeaway, a couple of valuable takeaways there. So thank you so much. I want to move on to COVID, and the pandemic. And I know that medical professionals, nobody was excluded from this pandemic, right? I mean, everybody was affected in one way or another, some more than others, certainly. But you know, I own a medical office building. It's a 48,000 square foot building full of dentists and pediatricians and oral surgeons and orthodontists. And I walked into that building in, I think it was April of last year, and there was not one car in the parking lot. You know, this is a huge building, and usually it's you know, I can't find a place to park, and we're looking at the restaurant next door for parking, and there was not one single patient or doctor or medical professional in there. And that was because there was an order in Utah that if you weren't directly on the front lines working with COVID, that they'd suspended all other medical related practices for the month. I think it was the month of April last year. And then, you know, obviously they went back to work a lot faster than if they were in the restaurant business. But my point is, we all were abundantly aware that there are risks that we hadn't been thinking of, and we needed a little bit more liquidity at our fingertips than maybe we thought we needed. And so I just wonder, going through this experience yourself, how did that impact your financial advice to the people you advise and serve?
Yeah, that's a great question. And you're exactly right. Nobody was immune to it. Now, and it's interesting because there was some of my clients, like the pulmonologists, right, dealing with the patients that were going on the ventilators, they were working more than ever. Right. But they were also exposed. I had several that tested positive for the virus early on. And again, a year ago, you get that positive test on the virus, and you're like, is this person gonna die? Like, you know, because we all saw the horrific things happening. Yeah, you didn't know, right? So we saw what was happening in Italy and then China, and young people succumbing to the virus and so forth. So early on, when everything was shut down, I had a lot of people. I had this surreal experience that a dermatologist called me up, and a great girl. She had just graduated the previous July or June, started work in August, new practice. Everything's going really good, like all these dreams and things that she wants to do. And then they call everybody in last March, probably about a year ago, pretty soon here, called everybody in last March. Office is being shut down. You're all furloughed effective Monday. It did this on like a Friday afternoon. So she calls me up Friday afternoon. What does furlough mean exactly? Like what exactly are they? Yeah. Like what does that mean? And I said, well, you don't have a job. She's like, but I have a contract. I have a contract that I signed. You know, they're contractually obligated to pay me $350,000 a year. And I said, yes, that is true. And but the reality is that they're shut down. They're not going to be able to pay you. Now you could seek an attorney. You could do all sorts of different things. But in this environment, do you have the time, and do you have the energy to do that? I don't think, you know. So I had this real experience of helping this person file for unemployment. You know, so imagine she's got her undergrad, she did a public health master's before she did, you know, her residency. I mean, this is a very smart person, and she's filing for unemployment, getting whatever it was, like $700 a week or something. So here in Florida, crazy. Okay, and then I also had the experience of other clients who we had been working with for years, and I shared with you before, but I'll kind of share the story here. probably about maybe 3 or 4 weeks into the pandemic when things were, really bad and you couldn't find toilet paper anywhere. You remember those days, right? So my wife calls me. I'm running errands on a Saturday, just trying to pick up some supplies. And my wife calls me and says, "Hey, I heard there was toilet paper at the Walmart over in Lutz, Florida." I'm like, that's like how crazy. Okay. So I stop what I'm doing and I hightail it over there. As I'm walking into the Walmart, I get up, my phone looks down and I'm like, oh, this client's calling me. I pick up Saturday afternoon, like, "Hey, what's going on?" They're like, "Oh, we just had a couple things happening. We just wanted to check with you." And we were just discussing, there are a couple of things. His practice had gotten shut down. He's a dentist. And I'm talking to him and his wife. And so as we're going through everything, I said, "Are you guys okay?" And it was funny because his wife said to me, now she doesn't work outside the home. They got a couple kids. And she said, "I just want to thank you." She goes, "I've been meaning to tell him," I won't say his name, but she goes, "I've been meaning to tell him, like, I wanted to say thank you because he got shut down. The office is closed. We don't have any income." And she said, "This has been stressful, but not to the point where, like, we're actually enjoying the extra time together. We take walks in the afternoon. We're able to do things as a family." And she said, "I want to say thank you because we cursed you out during the early part of our planning a couple of years ago because you were the one keeping us from doing all the fun stuff that we wanted to do. I didn't buy the Escalade and we didn't take the ski trip to, Vail right out of school because you said we got to save first. And then I got pregnant and then, all these things that happen, right?" And she said, "I just want to say thank you because our friends who didn't do any of that, didn't do any of the saving on the front end, they're really stressed. They don't have any income and they don't have the assets. Like we could," and she said on the phone call, she goes, we could be in this position for a year, which would stink to see our savings, just get eaten up." She goes, "But we could do this for a year and it's not going to impact us. At least it's not going to devastate us." And I really took that to heart. A couple weeks later, they were opened back up again. And actually he's about to close on his own practice. So like he was an associate before, but that's a great analogy or a great story because those decisions that we make when the stress is not there are going to have long lasting rippling effects across your finances. So so me saying to them when he was a D4 at the University of Florida Dental College and he's coming out of school and I'm like, "Okay, here's what we're going to do. We're not going to pay your student loans off immediately." "What?" "Yep, we're going to save as much as we can, 20 to 30% of your income." "Are you crazy, Chris? Like we're not going to pay the student. We're not going to do that right away. We're going to eventually pay it off." So our philosophy when it comes to all of this is that saving on the front end. But then when you do reach the point where you're like, "Okay, I've got the savings habit down. I am completely protected from anything that could devastate my ability to earn." So here's kind of a saying that I like to use, and I think it's very important, is that all of us, myself included, all of us are going to reach a point where our earned income is going to stop, right? So you're eventually not going to work anymore. Now, at the point, it's going to stop because of extended illness, death, loss of a job, loss of a license, or retirement. And it's funny because, I say sickness or injury, passing away, loss of a job, people go, "Oh yeah. And then I say retirement and they go, "I never thought of it that way." Like retirement, I'm volunteering for my earned income to go to zero. So I'm not going to do anything anymore for income. So my assets are going to be responsible for replacing my income. And so that's really important. And our philosophy is let's make sure that all of those things, whether it's tax increases in the future or, like a COVID, whatever event, that we have resources available. And then what we do is we save. And so typically what we have our clients do is we put not only their retirement bucket where they're saving into for future expenses when they stop working by volunteering, but we also have some side funds that we set up. And one of those is that student loan bucket. So when I say we're not going to pay back the student loans immediately, I'm not saying that we're not going to set up a plan to do that. So what we're doing simultaneously, again, bifocal vision, is we're building wealth, we're managing and protecting yourselves from loss of income, but then we're setting up that side fund. I call it a sinking fund. And as a business owner, as an owner of your building, think about it, like you probably have a slush fund set up so that you know that you're going to have to replace the roof on that at some point, or the plumbing, or there's going to be air conditioning issues, right? Eventually. So let's do the same thing with the student loans. We set up a side fund, and typically between years 3 and years 6 after graduation, or when we start working with them, once they are fully earning their income as an attending or whatever their career path is, usually about 3 to 6 years after that, that side fund has enough wealth built up inside of it that we actually can pay off the student loans, but we do it in one fell swoop. And so you're not paying all the interest because you wipe it out. Now, in the meantime, though, COVID hits and you're like, oh, I'm not so worried about the student loans anymore because the president just said that it's 0%. So I might need that money just to pay the bills. And a lot of my clients did that last year. They used it just to pay the bills. But that same one I just told you about, like I said, 8 weeks later, he was back to work. So he began the cycle over again, replaced the money that they had spent. And here we are about a little more than a year later, and he's about to close on his first practice. And he's only able to do that because of the habits and the things that we set up. So he was able to ride out COVID, and he's still going to put himself in a position where he's going to own his own practice here in just a couple of weeks. So if you do it right, and our philosophy, again, nothing's foolproof, and I would never say that there is anything foolproof. There's nothing guaranteed out there. But I really feel like our philosophy has been tested in the most difficult of circumstances. Like I shared with you before, COVID was the perfect storm where if our philosophy was going to work, then this was going to prove it. If it didn't work, it was also going to prove that it didn't work. And we've had great success. Nobody lost the practice. Nobody's gone bankrupt. Haven't had any clients, lose their homes, or really, if anything, it's just been annoying that they had to eat up some of that savings that they had built up. But if that's the worst you got to deal with in a time like this where it's just crazy, then fantastic. I think that's a huge win and a blessing for all of us.
Yeah, no doubt. You've been blessed and made some good decisions. Chris, you touched on something again there, and you didn't say the word arbitrage, but I want people to understand how important this is, and specifically because your financial planning advice and strategy is exactly aligned with our mortgage advice and strategy, which is that whenever you can borrow at 3 or 4%. And go over here and invest. If you look at the S&P historical returns over the last 80 years, it's north of 8% return, depending on when you in and when you're out. But it's probably double what the cost of interest is right now if you look over long term. If we talk about this investment that you're talking about with the client that's buying their own practice and their own business. If we look back in 10 years and look at what his rate of return on that money is, he may be 15, 20, 25, 30, 50% return. The point I'm trying to make is that the arbitrage between the cost to finance and what you can do to invest that capital, when you fast forward that 10 or 15 or 20 years down the road, you have a massive advantage if you can borrow low long term and you can invest at a higher rate. And to put this in perspective, ask yourself this question: why is it that Apple raised over $7 billion in bonds last year when they're sitting on whatever it is, $100 billion in cash? Why is that?
Right.
It's because they're freaking smart, and they know that they can take a 20-year or 30-year or whatever the length of that bond was at a ridiculous interest rate at 2%, and they can turn around and make 6 or 8% on that money. Do that all day long. Take that. That's just free money at that point. But people in their own household finances don't think like corporations. And that's really what you're helping them to do, is to think with that bifocal vision and just do exactly what the biggest, most successful corporations in the world do.
Yeah. And that's a great point. So we've been talking a lot lately with clients, keeping your powder dry for opportunities, because when you do have dips in the market, those are the times when it's good, but you need to be consistent with it. So for me, like I've used the analogy, I said, you want to lock in as many of the costs that you have like for instance, if I could go to my car insurance company, using the example like that everybody has to pay. So if I could go to my car insurance company and say, you know what, the amount that I'm paying today, I want to lock in the cost of that premium that I'm paying for them every single month, and I want it to be fixed, okay, for the rest of my life, regardless of what my driving history is or what my kids do or don't do or whatever. I want to lock in that cost. Same thing with, like you said, the cost of financing a house or the student loans. If the more fixed costs that I have, as my income increases, the delta between, you know, what I'm spending and what I'm earning is going to become greater and greater. And as you so well, you pointed out earlier, is that future increases to the income, I'm able to save more and more and more. And so I kind of started out our conversation by talking about weight loss and how people get stuck with a mindset of this way works more than anything else. But the other thing is that I like to think of it as I'm going to save more tomorrow, right? So even if I'm meeting with somebody who is in their 40s and I say to them, you need to be saving, 35% of your income, that is like, well, okay, do I take my kids out of private school? Do I sell the house? Do I get rid of the boat? Like, what do we do? I'm like, okay, so we know that you're going to have increases of income. So let's lock in as many of your costs as we possibly can. So that's your mortgage, that's the car payments, if you have them, whatever the case may be, student loans. Let's lock in those costs, those hard costs, so that now, as you do get increases in income, RVU bonuses or whatever the case is, we're able to save more of those. So let's commit to saving what we can today. Great. Okay, I understand we can't, the kids are there, like we're not going to take them out of the school that they love. We're not going to sell the house. You love the neighborhood, your neighbors, but let's at least commit to saving more as our income goes up. And that takes diligence, and it takes, honestly, from our perspective, takes a lot of time from the advisor. Most financial advisors are just about managing assets. If you don't have $250,000 of investable assets, they don't want to talk to you. And so that's just the reality of it, right? So if you go to like the big wirehouses, that's what they want. If you don't have that, you go to a call center. And so we kind of built the practice around this idea that there's all these other aspects of your life. You come to a financial advisor because you think that I'm going to give you alpha, which is the return of over and above what the market can produce. And realistically, no one can predict what the market's going to do. So let's manage the things that we actually have some agency over, some control over. And those things are your expenses. Those things are your decisions. And if you do it that way, you have greater success. And it's a lot more enjoyable too. I don't want to be the person that's trying to predict or pick gamble with somebody's investments. We're not going to do that. That makes no sense at all. And no one has done it consistently. So therefore, let's manage the things that we can control.
I love that. I think that's really, really well said, Chris. Well, all right, man. There's about 40 other questions I'd like to ask you, truth be told. But unfortunately, we are coming to the end of our time here. So I think we've imparted some really good wisdom. I think we're both on the same track that getting into the habit of savings is habitual. And once you start to see those savings grow, it becomes more rewarding oftentimes than, splurging on the shoes or splurging on the vacation, because you're seeing success in those actions. And don't delay the savings and putting away the nest egg. That's some great wisdom. We talked about the benefit of arbitrage and taking long-term loans versus short payoffs, especially if you can invest that money elsewhere and make the delta between the two. And I think we've dropped some really good information here. Let's end with two final questions, Chris. The first one is, and this is a bit of a curveball for you, but what do you think and we maybe already touched on this, but what do you think the biggest mistake you see millennials doing, let's just say young professionals making when it comes to their money?
It's funny, as you were asking that question, I would say following the herd. Okay, so let's use a great example. Recent just happened, Robinhood, right? So the whole Robinhood debacle that happened several weeks ago now. But so there's this herd mentality and the idea that everybody else is doing it, So I'm going to chase after that same thing. And there's a great Wayne Gretzky quote where he says, you want to go where the puck is going to be, right? So you don't chase after like a bunch of 6-year-olds on a soccer field, like all running to where the ball is. Okay. So I think that's really the thing is, and as a millennial, and this is hard for everybody, because I mean, I was in my 20s at one point, as were you, and you don't really know what you don't know. And I think that's whatever age you're at. So, in your 40s, I'm like, oh, I don't know what I don't know. And then you're getting in your 50s and you kind of have an understanding that there are certain things I don't know, right? So with age comes wisdom, oftentimes. But I would say that being humble enough to say, look, I just need some help with these certain things. And I don't know all the questions I should be asking. And from a scientific method, a lot of physicians and dentists and veterinarians, they are used to researching and academics, so they're constantly searching for knowledge. I love that. I love working with millennials because they always ask really good questions, like very insightful questions. And so a lot of times they don't have the air of, I've got this all handled, right? Like a lot of my 40, 50 something year old clients, when the reality is that a lot of those 40, 50 year olds are absolutely broke. They are 2 or 3 missed paychecks away from financial ruin, and they're making all kinds of mistakes. And yet their younger counterparts, the millennials coming out of school, are the ones who are actually, they watch their parents through the .com bubble. They watch their parents through the housing crash, and they don't want anything to do with that.
Yeah.
And so what I find is that they're looking for advice, but too often they sort of just, and they follow the herd. Like I said, it's a lot of like, oh, this blogger said that. And so I see a lot of they're buying whatever is hot on the market right now without really thinking it through. So, we do a complimentary consultation with everybody that we work with, and it's all via Zoom like this. And usually in that first meeting, I'm just trying to figure out, like, is this a good fit? And if it isn't a good fit, no harm. Like, we've literally got about 400 clients that we have helped over the last 11 years. We're kind of picky on who we work with. So we want to make sure that it's a good alignment philosophically, because if it isn't, it'd be like trying to walk a mile with an ankle that's out of joint. You could do it. It's going to be really painful. It's not going to be fun. So what we want to do is make sure that there's an alignment. If this person's like, I want to take the most risk possible, I don't want to think about anything bad ever happening to me, that's not a realistic assumption, right? So every day, unprecedented things happen, right? So how many times have you heard somebody over the last year say, this is unprecedented times, right?
Yeah.
Josh, it's precedented now, okay? I mean, like, you can stop with the unprecedented, because every single day, the mere fact that people say this is unprecedented tells us that things that we never thought would happen every single day. So let's prepare for that. Let's prepare as best as we possibly can for the things that we're not even thinking about. And for that, you typically need outside insight. So you need somebody from the outside to just point out, hey, you're missing this. And for this, we're going to help you with these other areas. And this, like I said, you'll make better decisions overall, and that's going to lead to much more success for everybody involved.
Yeah, well said, Chris. I love it. What I pulled out of there is be humble enough to take advice, and as you've said, don't follow the herd. If it's an emotional call, if you're feeling emotional to chase something, that's almost always a bad investment decision. Slow and steady wins the day. All of my best investments have been things that I knew weren't going to pay off this year or next year, but in 10 years, this was the right course of action. So I think that was really solid advice.
Good. All right. Well, I'm very happy with that. I mean, like I said, if your listeners, people on here, like, if they have any questions, like, you can go to the website. That'd be great. Or hopefully, I'd love to be on again sometime here in the future.
Love to have you, my friend. Yeah. So let's quickly, if you would, leave a website, or what's the best way for people to reach out to you if they have additional questions? Yeah, that's great. So the website is, and actually you said it at the beginning. So we're nationwide. We are a fee-based financial planning firm. In our website, and again, if I had the time machine, like Back to the Future, I'd go back and talk to myself all those years ago. Like, don't use a regional sounding name, but we did, and here we are. So it's FloridaMedicalAdvisors.com is the website.
That's all spelled out, floridamedicaladvisors.com. And on right there on the homepage, you'll see that you can, schedule a meeting, and it goes right to my calendar. You get right onto my calendar. If I'm not available, it'll schedule to the next person. But it's really just a couple of advisors, and then we have our staff. So if you go to the website, you'll see a couple of the main partners there, my partner Trip and Seth. But yeah, so that'd be the best place to go to. There's some information on there, but that's kind of like evergreen information. If you really want to have a consultation, again, it's complimentary. Be happy to schedule something, and we could do that. But we're fee-based, fiduciary perspective. So obviously, what's in the best interest of the clients, irrespective of what we would be gained from it. That's really important. You want to make sure that you have an advisor that is a fiduciary. And then making sure that you're paying for the advice that you need, and it's going to help you long term. So be happy to help anybody on the call.
Thanks, Chris. I appreciate you sharing so generously with us and sharing your time with us. I know it's a busy season for you, my friend, and look forward to having you back in the future sometime.
All right. Thank you very much. I appreciate it. Thanks, Josh.
Thanks for listening to the Infinite Financial Freedom Podcast. Subscribe to us on Apple Podcast and Spotify to be notified of all future episodes, and follow us on social media to join in on the conversation. If you'd like to learn more about Neo Home Loans and how we empower homebuyers with financial literacy and guide you on your journey to financial freedom, visit neohomeloans.com.